Thanks everyone for visiting the Traders Lab. I'm your host Tom B, and I stream live Monday through Friday, 11:30 to 1 p. Eastern Standard Time, and I appreciate you all stopping by to visit the lab today. This stream is for educational purposes only. It is about integrating bookmap order flow tools with auction market theory. In other words, how the market works based on participant behavior, the interaction between buyers and sellers, and also using a tool called the volume profile in the intraday developing time frame, price and volume versus price on its own. All prices are not created equal, and based on the volume at price can potentially give us insight into participant intent. Not only intent, but areas of potential exhaustion, whether it's buyer exhaustion or seller exhaustion, and at the same time, where is their potential agreement on price or retail. The thing about an auction is, think of this like shopping, and the buyers and sellers are interacting to try to figure out what is this product worth. So the market moves from location to location, and it does it in all time frames, or as I think, fractals. And if we can identify these behaviors in alignment with the actual context of the market, we may have an opportunity to get an alignment, and then, subject to a vetted trade plan, interact with the market. And then, of course, the outcome of any interaction is random. So what you're going to see here, and what I do every day, is the top-down approach, top-down, higher time frame, and drilling down into intraday developing time frames down to micro structures to potentially interact, or triggering structures. And this is what we do every day in the Trader Lab. And those of you who might be interested in following this stream, so you can understand the terminology and also the setups as they show up in advance, you're invited to go to the Trader Lab in the Bookmap Discord chat and download 60 PDFs of setups and overviews of potential behavior so you can track. This is not a trade calling room, so if you have this um, information available as you follow the stream, you'll get a lot out of it, I think. And again, thanks for visiting the Trader Lab. Let's take care of some business. General disclosure: all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice or recommendations. Live trading is in simulation demo paper trading mode and strictly for educational purposes. Live trading executed in simulation cannot accurately represent realistic trading performance. Risk disclosure: trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. An investor can potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should be consider trading. Past performance is not necessarily indicative of future results, and please remember, this is not a trade calling room. This is really a trading process, and the goal of the Trader Lab is to help individual traders create the business side of trading, to understand how the business of trading works, and to potentially create career paths for individual traders subject to trade plans they can create and vet. Now, why would we vet a trade plan? The business of trading is a math-based or statistically based business. It is very much operates the same way a casino operates. And if you can separate yourself from the mental aspect, the need to be right, the adrenaline, the endorphins that are released, the fear that's triggered, all of those things we feel. Um, the house, the casino, is not an emotional participant. It is a statistical participant. It executes. Their execution is dealing the cards and knowing that by doing everything the same way in a consistent process, that they have a statistical edge that shows up. And over time, the dollars flow from the gamblers back to the house. That is what's called an edge. And in trading, it is really about creating trade plans that have a statistical edge. And then the hardest part for traders, assuming you get to the place where you actually know you have an edge, and how is to actually execute, and so you can derive the edge. So in the Trader Lab, it's about building out a process so you can identify where your edge might show up and helping you understand that this is a metrics based game and that if you have the edge, the gamblers, the typical retail traders who are just basically slamming indicators over rotations or using random inputs over time, statistically, unless they have a vetted plan with a statistical edge, they potentially will not be long for the business. The business is a math based business. The outcome of any trade is random, but if you have a statistical edge, it gives you the confidence to be able to interact with the market because you understand that losses are really cost of production. And when you take a loss, you are protecting your account. Losses are overhead. The casino pays the electric bill, they give you the buffet ticket, send you to the show, pick you up at the airport, maybe comp your hotel. And they still are building bigger and larger casinos in Vegas. Think about it. That's where we are, and that's the business of trading. So let's go take a look at the business of trading and let's go take a look at how we start our day. Now, let me go back here one day or two, actually. Now, you remember this is the day before yesterday. And on this day, the market made a new high, but left this wick and closed near the low of the day. That was potentially, now you don't know, right? Like everything in trading, it's maybe. But what we had was, remember, we broke out of this consolidation, and you want to remember this number around 38.60. You should write that down. That's going to be a higher time frame target for the current move that we're in moving down. Yesterday, we opened, we went to the overnight high, and we discussed this in the stream, and we failed to take out this high. So this was your potential underlying exhaustion. Failure to take this out brought out the sellers and the longs. Now you have to think from both sides. The longs had their stops under here, under here, under here, and under here, and this was a small gap. So yesterday in the stream, we were talking about potential to get under these areas. Why? Sellers. And if you're long, what are you doing? Subject to the time frame you operate in, you're trailing your sell stops. Sell stops become sellers, right? So you guys know that. So yesterday, what do we have? Market fails, and this is called a trend day. In other words, it wasn't a rotational day like this one. It was, I'm long and I'm out of here. All these longs became sellers. So that's what leads to potentially outsized moves. And look where we went. Fill the gap. Isn't that interesting? Sell stops, sell stops, sell stops. Now, let's take it next step. What would happen today? Now, let me take you back to yesterday's close, and then we'll be ready to get into today. And remember, if you're in YouTube, there's a 15-second delay. If you have questions, post them in there. If they're related to the current discussion, if they're technical questions, as far as support or anything, you can go to bookmap.com if it's related to the software. And I'll do everything I can to try to answer questions that are applicable to everybody. And again, thanks for being here. And if you do want to follow the stream, remember there are 60 PDFs you can download so you know in advance what we're anticipating. And when the setups show up, you'll know what we're referring to. And again, these aren't trade recommendations, not a trade calling room. So what I do is I go back, like I am here, get to the higher time frame, because we trade inside an intermediate time frame, but we need to know the lay of the land. What's the condition of the market? So here we are. Now, yesterday, and I posted this in the Trader Lab, and I don't, if you're in the Trader Lab, what we had yesterday was the volume point of control. Remember what the volume point of control is. It's the highest volume price. What is high volume? think of when you go shopping, it's like going to the store, you know, retail. Seller says, yeah, I'll sell it to you here. Buyer says, I'll buy it here, and everybody is wonderful. But it's at the low of the day. That means everything above us was unfair. In other words, too high. We close at the low of the day, settlements at the low, and the volume point and controls at the low, and it's cut off at the bottom. What that suggests, and everything I always say potentially because that's all you have in trading, that suggests continuation. The market basically the door got closed on the market before it was finished. You know, market says, hey, we're done, everybody go home. But the auction, the price discovery process was cut off. So and based on that close, and this is what I posted in the Trader Lab, and it's not so relevant that I post something, you know, because anything can happen. But based on auction principles, it was cut off too soon. So we opened in the ETH and then the selling continued. And the reason was that we weren't done. We were looking for excess and we weren't there. So that's why this morning when we came in, we had a gap because we continued the selling because the auction was interrupted. And this is our gap. So now we're going to get into real time. Now there's a couple things that happen, and those of you who are in the Trader Lab and potentially been following the stream, what might we anticipate when there's a gap lower open? Anybody? I'm getting a question. What the higher time frame charting is Investor RT, um, and I've been using it I think since 2009. So you know, and for what I use it for higher time frame and for statistics and all, it's a very good tool. Let me try to get back here to YouTube. Sorry, guys. Okay. Thank you. Yes, responsive buying. What are, and let's think, why would you have buyers? This market looks like it's going, you know, wherever, south of the border. Everybody is looking for the exit. They can't even get out the door fast enough. So who would be buying this, right? Here's who might buy it. Imagine you had gotten short yesterday and you are more of a position trader. You hold positions overnight or a higher time frame trader. You get a gap lower. What might you do? Is it reasonable to think that you might respond? Respond. That's why it's responsive. Respond to the gap and cover. Think about it. Is it logical? Would you sell the gap? Maybe some. Or, and think about it. There, of course, there might be sellers on the open. Oh, I got to get out of here. They might be just liquidating. But would there be shorts coming in the market as in short-term traders also? What would happen to them? Well, they're going to come in. They might sell. We might get a little selling. Those buy stops come above. And if you're sitting holding a short in a gap and then the market starts rotating up and it starts feeding on the buy stops, you might cover also creates more buying. So you're responding if you're covering. And if you sold in the hole and you have buy stops, you are covering. So buyers, buyers, buyers. Now, the thing about it is, if we think the trend is down, what do we want to do about that? Do we want to get long? Or do you think maybe we want to wait or attempt to wait and then look for opportunities to get short? That's up to your trade plan. But so let's take a look. Okay? Is everybody with me? That's right, Tony. Okay. So this is the open. Now, let's take a look at the lay of the land, right? Couple of things. This is going to be our cash open. Remember, we had a target down at 39.19. Isn't that interesting? Now, let me show you some key things. And we always go over the levels. When you trade the auction, which is what I do, I'm not just trading out in space. Now, yes and no. I know what creates levels. This is part of understanding auction market theory is to know why. Now, we don't know what will happen ever on any trade or anything in the market. You know, that part is all random. But if we understand what creates something, and what the nature of the market mechanics are, we might underline be able to anticipate. And I think in trading, if you can recognize a condition of the market, and then setups are about anticipating behavior, and then locations to interact, trigger, put your risk on, and then have an idea of what might happen. That's about as deep as it gets in trading because we don't know what will happen. So then it's about what is the context of the market? Context means condition. What is the potential based on the condition of the market? Where might the condition or the location exist to interact? And then where might a trigger show up to help you get engaged in the market, manage your risk, potentially get risk neutral, and then go on to the target? And everything is random. Remember, we talk about a statistical edge, right? So let's go back. This is the overnight volume point of control. Volume point of control is retail. So for the ETH, the most volume was down here. Okay. That's like retail. So overnight ETH session, think about your store when you buy a product. You pay retail, right? Well, that's the fair price. Now, if the market moves lower, the participants, if they think this price is fair and the market moves lower, they may think, well, it's on sale relative to retail. So they may buy it down here and the market might come back. And then the market can go on the other side. Well, what's too high? And then potentially come back and check. And it does this in fractal. So we're going to look at that. But here's a couple things you need to know and write this down if you're not familiar. And again, thanks for visiting the lab. And I also want to remind you guys there's 60 PDFs of what we're going to be talking about here. So you can also anticipate, just like we do in the Trader Lab, where our trades might show up. And remember, the outcome of every trade is random, and that's why this isn't a trade calling room. But after we do some of this, looking back on how the market develops intraday, which is the key to staying in alignment, we will get into real time. And now that the market's moving along, I can't see it. So for me, it's like looking at it for the first time once I get past our setups that we had this morning. There's over a 90% probability either the overnight high or the ETH high or low will get taken out during RTH. Write that down. There's probably, and I think it's, I don't have the statistic handy. I think it's maybe 60% probability we'll test the overnight VPOC. Don't quote me on that. I have to go look at the stat, but I know that, and I'll explain why it's an important stat. The initial balance, high or low, is the first hour high or low of RTH. There's over a 90% probability one of these will get taken out. So over 90% probability this will get taken out during RTH and this, and also the IB high over a 90% probability, and it's one or the other, or the overnight high will get taken out. Now we know where the overnight high is. It's where we closed yesterday. So not so much. So I think it might be reasonable to think if we have a 90% probability, it would be this. Does that make sense? So before the market even opens, and we're going to have a gap, we anticipate these as viable targets. Is everybody tracking? This is the lay of the land. This is before put the first trade on, unless you're trading ETH. You see? So now we know potential targets. We know what happened in the ETH. We know this is retail in the ETH, and we know we have over 90% probability of taking the overnight low out. Past performance not necessarily indicative of future results, and we know responsive buying. So now that's what we know, and the market hasn't opened yet. Is everybody tracking? Very important. This is what a trade plan is about, okay? Before you put the trade on, you anticipate. Now, what you're going to be looking for is locations to potentially interact. Does that make sense? And I'm checking in YouTube because I think they passed out. I always get concerned. Guys, should I send the ambulance and the oxygen? And if you're in YouTube, make sure you're on 1080p. I got to see what's going on in YouTube. I think they fell. I think somebody hit their head on the monitor. Okay, great. Thanks. Hey, John. How are you doing, John? Haven't seen you in a while, John. I'm still waiting for you to ship a pizza up this way. Okay, let's continue. Um, so this is our open. Now you know the lay of the land. So let's look. Remember, what are we looking for? Potential selling the gap, buy stops, responsive buying, profit taking, and then because of our statistics and we are away from the last retail price, the potential to come back down. And then that's going to be, so we're going to look potentially for something called mean reversion. So all this is all happening before the market even, there's the first tick. So now let's go. We all ready to go? I hope you find this useful. Because to me, and I'm just giving you an opinion, I'm not saying it's right for anybody. For me, I got to do this. This is what a trade plan is. What's the lay of the land? What's the probabilities based on statistics? And by the way, you need to vet these statistics and you need tools to do this. No matter what you hear from anybody, and remember, I'm not a vendor, but whatever you hear, it's important that you confirm them. And let me tell you why confirmation is important. It creates belief. The more belief you have, the more courage and the more discipline you'll have. Because the more you can believe something, the more you can act on it and manage the monkey, that emotional state that is the crazy. It's like Jekyll and Hyde. That's how I kind of think of it. Hyde's the lunatic who talks in your ear and scrambles your intentionality. That's something that we all live with as traders. And that's the biggest obstacle you'll face as a trader. Everybody who comes to trading thinks it's the setups. I've got 60 PDFs that are yours. They're all setups. So you can enjoy yourself with that. Not the problem at all. And this is what we do in the Trader Lab, by the way. There's no secret, guys. Everybody holds their cards and think about it. Now, by the way, here's your open, a little selling. And now what do you see? Here's the buyers. So let's watch. Now, you guys have followed the stream. You know how we use the tool. This is called the developing volume point of control. What is it? This is based on auction market theory, and it's very simple. Volume and price, remember? Is this volume too low? And if the price is moving higher, is volume moving with it? Now we anticipate when the market opens, remember there's no volume. So this is reset to zero, this, and this. It starts here. And what this is showing us here at the moment is the volume at the price. And it's the same thing over here. Now, what's going to happen is as this develops during the day, this is all the volume for the day. And there's a reason why this is important. It isn't just you see a blob over here. It's what happens in this and where does it happen. As the market's moving higher, the volume is moving with it. Observe the behavior. Too low. This is like shoppers, right? Remember, participant behavior. Too low, too low. I'm going to turn this off so you can see this clear, just temporarily. It's a liquidity marker. It's really cool. We have a heat map that shows us, the order flow in the order book. That liquidity marker actually shows how much trades, how much pulls. It's a nice little tool, and it's, part of Bookmap. Um, but in actual live trading, it's pretty useful, right? This depends what your priorities are. There's so many tools you can use. But let's look at the auction, okay? This is migrating higher. You see how it tests? Is this too low? And we blast away from it. Notice what's happening. Think of this like shoppers. This is my, and I'm telling you, I'm very simple. We all think trading is complicated, and I think we need to make it complicated. So we think we're going to find that secret pieces, what do they call it? The needle in the haystack, and that nobody else is going to find it but us. I have to tell you, why does a software package have 80 to 100 indicators in it? Do you think maybe we only need the three or two or one that really works? Why did they keep adding indicators? I'm going to suggest maybe because none of them work. You're going to probably be, oh no, I've got one that works, and maybe you do. The reason I say they don't work, it's not that indicators don't work, it's that traders don't know how to deploy indicators. It's a whole different bag. A lot of us as traders think that it's a matter of putting the right indicators together in the right time frames and all of this, and we're tweaking and tuning and mixing. I don't know if any of you ever did it, but when I built trading systems, in essence, that's what I was doing. Um, but what happens is you're kind of putting, as they say, the cart before the horse, because indicators are context specific. And when you have a generic process, the market moves in different waves, different behaviors or conditions. Part of a trade plan is differentiating the condition of the market. In other words, yesterday was a trending condition. Today, at the moment, in this situation with responsive buying, and here's your buying, is not a trending condition at the moment. It is a responsive condition looking for a outside edge to get short. That is the plan. So it's not trending at the moment. It is counter trending. So let's watch the behavior. So retail, too low, too low. So as the volume is moving with price, that is suggesting at the moment we are going higher. Now we don't know. Remember, nobody knows. This is like what, where, how. Watch. Now we are anticipating a seller somewhere. And of course, this gets, I think the term is tricky. This is your two-sided trade. Now here, so here's what you have. Let's look. Right here, I call this a variable high volume node, and I mark them. Now I don't know anything about where it might come, but let's remember what this was. Too low. So I go over here, and we do this in the trader lab, and we mark it. We go, okay. We call it a variable high volume node. All it is high volume. And remember what creates high volume. It's the interaction between a buyer and a seller. And let's look where it is. Let's come back. This is how the auction tends to work, okay? Watch. This is the open. And remember how this was going. Too low, too low, too low. This is another one. Watch. Just watch what I do here. Now, I have no clue. Remember, I'm the clueless. And I do that because my mind absolutely must be open. So I'm interpreting. And what I do is I do something called if this, then that. If not, then what? So if this is moving up and this is moving with it, then what? Then up. Okay. Now I'm looking for a short. Now I don't have one. This is moving up. Right here, it breaks. Now, under different conditions, this would be a short, but this is too close, and I'm nowhere here. If you're aggressive, you could short this, but your targets would be mid, potential VHVN here, VHVN here, and maybe lower. Okay? This is very tough trading. But we test here. If you can't get below here, it is saying too low. And that's why you see the reversal. Now, nobody knows what it's going to do. What we do in the trader lab, though, is we mark these as potential areas to observe. And remember that we're looking for the responsive buying. Now, let me show you. This right here, now we're looking for selling, and this is called mean reversion. If you're not skilled at this, this is nothing you would do. You would just hang out. Into liquidity, this is a potential, let me show it to you, triggering structure. Here's your trigger. Let me show you a trigger. And guys, this is worth screenshots if you find this useful. Let me explain how a trigger might work. What is a trigger? A trigger is a consolidation. That is basically what a trigger is, because every time you have, it's always buyers and sellers, buyers and sellers. The market is moving higher. We run into this liquidity, 26 buy stops. Remember, we'd have sellers, we'd have shorts in the market, we'd get buyers, and we're looking for something called mean reversion. The market needs to get outside, away from this. This is retail or the mean. You don't know where it's going to show up. That's the fun part of this and the hard part of it, too. So you don't know. But here we have confluence. Let me show you. Here's the trigger. And you can grab, no, thanks, John. I'm looking forward to it. This grab screenshots or come to the Trader Lab. You can review these streams. They're up for 24 hours if you're interested in them. You might want to record or screenshot things you find interesting. So the trade is to try to come back here. And that's what, remember I said at the beginning of the stream, we're going to try to find an outside edge. And where's the outside edge? And that's where, of course, uh, problem, challenge. But here's what it looks like. This is a chop chop. Now, what is a chop chop? Consolidation. Okay. So the market is moving up. You see the energy. You see the chop here. It breaks high. There's micro high volume right in here. This is like retail. Think of these like stores. This is how I think of them. I had to kind of get, simple, right? Keep it simple. Let's not be complicated, because I think the mind, at least for me, I need to relate to something else. When you look at this, I mean, what the heck is that, right? Well, to me, it's shoppers. And it was these guys interacted. Buyers, too low, too high. Retail is right here in this little store. And you can see it. Let me show it to you, just so you know what I look at. This here. There's that little volume. And it's just a consolidation, right? It's nothing big, no big deal. So we're up above, and I'm going, okay, come outside somewhere. Now, right here, you look at this, and I'm going, okay, maybe that's it. That's not very far. Buyers, consolidation, break. Where does it come? The volume, too low. So this volume in here, too low. Chopping, volume, break, too low. 26 stops, break. Now I'm looking at this. We hit this. We got buy stops. There's less stops as we go higher. Divergence 101. It's the only thing I remember from indicators at this point, because that's all I use. This is the stop and iceberg detector in Bookmap. It basically is measuring the amount of stops based on market by order data provided from the CME. So we actually know that's the exact number of stops that went off. Okay. And because we can open this up, we can see. Now, this looks like a potential short. So I'm looking at it. Now let's look. We come up here. There's only one stop. There's only one, and they're lifting here. They're not going anywhere. So let's watch this. This is potential exhaustion. Watch. Here. Right here is high volume. Right here. And what's different? No buyers. 2 stops, 8 stops, 26. You see the difference. Let's look. Sellers. So I have sellers. We come back. Less buyers. Less buyers. See? Than this guy. Higher. Nobody's lifting. 8 stops. This is a triggering structure. So let's watch it. And what's the target? This. Okay? Mean reversion. I'm taking my time because I like to show you guys this stuff. We break. Now your volume is right there. In other words, retail in this store is there. Break, you'd be getting short in here. Your stop would need to be up here, and your target is here for scale. And then whatever happens, happens on this thing. Now, let's watch. Price check in the aisle. So let's look at price checks. In the microstructure, same process as this. This is fractal. So this, too high, short. If you didn't get in there, you have it here, but more risk. Up to you. The high volume is where the trade fails. So, you could be in here. You could be in here. If you're quick, you could be in here. It's all subject to. If you can't get in it within your risk reward parameters, there's no trade. There's plenty of buses coming by. Market breaks down. If you had gotten your short on, you'd be risk neutral. Very important. The next trade, now let's go back. Let's remember what's going on. Variable high volume node, too low in the microstructure. Pull back to here in the next higher time frame. Potential short here and here. If you got a short off here, you have to get scaled before here. If you get a short off here, you have to get scaled. So let's just see what it does. You'd be stopped out if you took it here. If you took it here, you'd either have a scale or you'd be stopped out. This is the real world. I can't make it any different than it really is. So, and it was very choppy. So now we're up above here. And we're looking again for this. So the context, so you understand what it is. It's rotational trade, two-sided trade. Not my favorite environment because we didn't just come back, and then go south of the border. Remember what our targets are. Overnight volume point of control and overnight low. So the idea with this whole thing in here is to try to get short to come back again to here. Same trade, different location. So let's watch the behavior. See. So it's the same. This trade here is the same as this trade. That's all. Just the way it is. Short, boom, no bueno. Oh, well, actually not bad. Short, scale, or no scale, scratch. Short, no scale, stop. Real world, guys. This is trading, Everybody takes stops. And the thing about a stop is we experience it emotionally one way, but the reality is the stop is just cost of production. And we really need, and this is exhaustion, you see it? One stop. So this is showing you the exhaustion, and this is a very hard trade to get on because it didn't give you, look at it, bang. So right here, there's just no way to get into this thing. You have everything you want, except you would have to get in. You would really have to be in this, in here. And this takes skill. And if you don't have it, it's no big deal. I'm just saying, this is part of what you have to kind of learn. You have to learn this. But let me show you the trigger. Chop, chop. We're chopping. We have these buyers. Then it gets hit with the sellers. Okay, it's rejected here. We're breaking below this volume right there. That's your retail. You can see it over in here. Now this becomes resistance. Now this might be too aggressive for you. You might not like this. So it's not your trade. But where are we going? Back here. mean reversion. This is the same context, you see. And where's our targets? Let's go back. Here and here. Now, depending on your skills, you can be slipping and sliding in between this higher rotation. And that's up to you and your trade plan. Or you just putting it on and you're managing it. Let me show you this. Right here, you see, and was very choppy. It was a very annoying trade, I will tell you, because it took a lot of stabs. This is now your variable high volume node, HVN. That's high volume node. It kind of, I have this set up from Investor RT that these are automatically populated. These are cloud nodes, and these are these micro high volume areas, which are like little retail stores, also automatically populated. Thank goodness for that. Let me mark this, I think. That in there, and then we'll continue. Thanks for your patience. I just got to keep up with this. So the volume point of control shifts from here to here, and you can see it's ping ponging. That's high volume. The market is trying to figure out what it's worth. If this is too high, and we can come back and check it, and the market says, nah, I'm not going to pay that, then we have that potential underlying, and that's all you have in trading, to come down. Now, this is a high volume from the ETH that was retail back then. So what the participants are trying to figure out, where's too high, what's fair. And remember when we started how the volume point of control was moving up? Well, now it's potentially starting to shift. And if it can come down, it's going to say this one is too high, and this becomes resistance. Remember, who knows, right? Very choppy. See the behavior back here? These are selling opportunities. Back to the volume in here, selling opportunities. It is not easy because it's like, almost like it's flying a plane into turbulence. So this is turbulence. So you'd be looking to sell against here. This is your selling structure. And you're going, don't forget, for this. Comes back and tests where? Here. Guys, it's horseshoes and hand grenades. There's no precision in this. Too high. Selling. So let's see what it does. And you'll notice this, even though it's moving around, is shifting down. It's shifting lower. That is saying what's above it is potentially underlined too low. This is a target, overnight volume point of control. We got that target. And the next one is here. So we got that target. And there's another thing I got to mention to you guys before I forget. We have a setup in the Trader Lab called the IB continuation trade, and we have something called the IB failure. Two trades. In this context, there is no long. The IB failure is a counter trend trade, okay? And it's again subject to your trade plan. The IB failure, so in other words, there's two ways to play this. It comes back to the IB, remember, initial balance. And I have to remind you guys, there was over a 90% probability to get down to the overnight low, which is a target, right? And the first hour, which is already passed at 9:30, so the initial balance, which is the low, first hour is there. So over 90% probability we're going to take it out. I consider that gives me what you might say courage. And based on what we already discussed before the market even opened, you knew I was trading towards these things. This is what a trade plan is. Now, whether it works or not, any individual trade does whatever, no clue. Remember, losses are cost of production. So we have another trade here. Now, this is called, and I'm going to show them to you, Now, if you're already short, you're not going to be doing anything with this. But here's something, and I'm just putting it out there as something that you could consider. It's not a recommendation. We have two setups. One of them is what's called the IB continuation. Remember, over 90% probability we're going to come out under here, and our target's right below it. So I felt pretty good about that. So, and I still have this open, right down here. So oh 07 to what about 13? So break under the IB, pull back, potential short add here. The overnight stat is still open. You see? So here it is. You're short from wherever. Fine. You have a selling structure right here. See the high volume, break, pull back, potential short here if it's part of your plan. Break the IB. Watch. Now I'm taking you into microstructure, and this is not a recommendation. It's just the way you can dance with it. Here's your high volume right in here. Break, pull back to the volume and to the IB for what's called the IB continuation trade. And you have this still as your target. So it would either be a short here, an add, or nothing. And you're going to your next target. So what you could do is, if depending on what, you could be short off of here, right here. You could be short off of here. You could be short off of here, and you're still going for this. Or you're just short here, you wear a helmet, and you manage the trade. Up to you. This high volume is support. You could be putting trades on back to high volume and scaling, getting risk neutral. That's how I use them. Pullback, high volume, location for the continuation, stop pick over the IB. It's a requirement, not necessarily, but just me. Short again, statistic over 90%. That's why I could add here. Are you guys tracking? Hope it makes sense. I don't take the IBF in a downtrend. I'm getting a question about the IB failure. Um, that is not a long for me. It's not qualified in this context. For me, it's outside in, mean reversion, to try to get alignment after the responsive buying. Remember? Then it's about my statistics down here. If I get the IBF, which is a mean reversion trade, then I am looking to use it to get back short again, back to the IB low and then wherever, you know. That's how I use it. So for me, so let's take a look at how this plays out. Does that answer the question about the IB failure, why you would not get long, but you would use the IB failure, which is a long setup that is not qualified in the context for to get repositioned for a short. Does that make sense, guys? And if you're in the YouTube and you don't know what this is, there's 60 PDFs you can download of setups, so you can follow the stream and you'll know what we're talking about and what the mechanics of the trade is. And all these setups are based on the auction. In other words, participant behavior. Uh, you know, not an indicator. It's based on participant behavior. So we're going to see an IBF, but there's no long. Is everybody with me? Are you guys tracking? How about in the Bookmap Discord Trader Lab chat? And how about in YouTube? Kevin, Kevin in YouTube is asking, how do we know it won't fill the gap? We don't know, Kevin. But given the condition of the market, I would say that if here's another way to think about this. Those who are short and are holding shorts either there's a gap, They see the buyers come in, it feeds on itself, and there's going to be buy stops. The sellers that sold the gap lower also have buy stops. They're going to be in there. So that creates the buyers. Is it going to fill the gap? I have no idea. What are the probabilities in this context after a trend day down? I would say not high probability, but anything can happen. So what I'm looking for is statistics. Remember, the overnight high is pretty much we opened where we closed yesterday. Is it with the kind of gap we have? What are the possibilities of actually closing that gap? Who'd want to be a buyer other than somebody covering? Do you think those who are still short might want to use any kind of upward rotation to sell? That's kind of the way to think about it, I would say, Kevin. At least that's how I think about it. And I also know it could do anything, you see? So if it did that, then that's what it does. And if I'm trying to get, and what I'm trying to do is get on the short side because that's the trend. That's why I go over that higher time frame, and remember, any one interaction with the market is just a random event, really, as far as what might happen. I see a trigger. I'm trying to get in alignment with it for my statistical edge, which is very important, guys. I know over 90% probability either the first hour high or low gets taken out. I know this was retail, overnight volume point of control. Remember, this is the developing volume point of control, retail. And the market is telling us it's too high. I'm not paying that. I'm going elsewhere. Oh, let's lower the price. Retail. I'm not paying that. That's too expensive. Well, let's go back and check ETH. Is that the fair price? Hmm. Too expensive. But what about this? Over 90% probability. The overnight low. I mean, that's the low. Let's check this. Okay, that's why all these were targets. Then it's in the clueless mode. Now, the trend is down. So, and I have, other targets, but let's go see what it does from here. Let's observe it. Now, watch. This sets up something called, again, the IB continuation. It also, if we come back in, it's going to set up a retracement. And where are the stops? Let's start thinking of like a retail trader, but not acting like one. Stops are going to be up at the VWAP, the mid, and here's retail. So if this becomes too low, now look where we are. We're underneath this, and our stops are up in here at this outside edge. So we'd be looking for it to potentially go lower and continue down. Again, nobody knows. We're in the I don't know. Did we get back to the IB? We did not. I don't think. Let me look. I wish I had lines here so I could see better. We did not get back here, so there's no short here. But now let's watch a little further. This is called the IBF. Now, the IBF, I call it the IB failure. And what it is, so you know, is this is that first hour low. This was our overnight low, which was our primary target at the moment. And you can see we got that. We came back and tested it, and we rejected it. There's micro volume in, let me show you how you might do this. Now, this is not a long, right? For me, I'm sure there's some of you out here that think you should be buying and selling everything. I don't have that skill. My skill is to try to stay in alignment and take trades where, so shall we say, the wind might be at my back. I know the market is short. Let's go back to the rationale. The market's short. What's above the market? Buy stops. So there's always two sides in the market. And if the market gets lopsided one way or the other, and it runs out of momentum in one direction, everybody who's sitting short potentially is going to cover. And we don't know when or if that'll happen. But right in here, take a look. You see this here? That's high volume right there, that little node. That is created by this right here. This chop. Now, you don't know. I don't know. What do I know? I don't know. But here's what I see. And so when I'm watching the market and trading, I'm in a narrative. And here's how, and write this down because it'll help you keep aligned with the market if this is a time frame you're interested in, operating in. And I'm interested in operating in this time frame because the more micro I can get, the more I can better potentially manage my trade or see when there might be a change in the condition of the market. And again, nobody knows. It could just give a little rotation. So there's the mystery of the market, right? That randomness. Right here is your high volume. There's your break high. This potentially becomes a buying structure. Now, here's what's important where it happens here. It's not, it can happen anywhere, but it's more important because we're just testing below a key target. Break high. Now, this is support. Now, I'd like it to take it out, wouldn't I? It doesn't. It comes back. Now, where does it come? Look, against the volume. It needs to get under here. Now, if you're trailing a stop, you could be out of this thing right here if you were short, if you were holding a position. Comes back here. Now, if this had checked this and we had a triggering structure, it would be another short. It did not. It breaks. It does not take this out. Subject to your trade plan, you'd be warning Will Robinson moment right here. Right here. See the volume? Checked it. If this is too low in the micro aisle, then potentially up. And you don't know. See, nobody knows. No, don't know. But anyway, it goes up. So that's why you need to vet trade management processes. Remember, in a random environment, you're never going to catch all of it. You're going to always rack your head and think you should have done something different. So let's take a look at the next trade. This is called the IB failure. It's a mean reversion trade. The mean is the volume point of control. We have the mid, the VWAP, and the volume point of control. So let's look. This shifts down, right? Too high. This sets up a potential short. Let's watch it. You have to scale here. So, so your short would be here, here, here. Scale has to be ahead of this and then hold. And then I don't remember what happened. Oh, there you go. These are Trader Lab setups. Is everybody tracking so far? Are you guys with me? How are we doing in YouTube? Guys, these are just setups, and it's based on what the market participants are telling us about value. Remember what the purpose of the market is to try to figure out what's this thing worth? What are we going to pay for this S&P? Do we want to own one of these? I don't know. So look where you come back. Here. So this is the area to short back to here. So this is a setup called the IB failure, which under different conditions is a long. For me, not so much. For me, when I see the setup for a long that doesn't fit with the context, in other words, I understand it's a long. It's not a long. It's a long setup, not qualified in the context. Remember, setups are context oriented, but when we see one that is not in alignment, at least for me, my plan says don't get short now, wait, because the IB continuation trade, in other words, I'm sorry, the mean reversion outside in is a stop pick. That's how I see these. And if this is too high and we have the mid and the VWAP, what happens in the downtrend at the mid and the VWAP? Might we get sellers? Right? So this is a short here, stops above here, or this shifts down. I'm not paying that. Here, here. See the volume? Break. Here. These are all short locations. Stops are here. You get in here, your stop is here. These are Trader Lab setups. And if you don't have the 60 PDFs of all these setups, I encourage you to visit the Trader Lab, download them. So when you follow the stream, you already know what we're going to do, you know. That's why this isn't a trade calling room. I don't need to call them. You'll know where they are. Then it's just a matter of watching triggering structures and seeing how they show up. So off on the short. Here we go. Now where to? I don't know. Here's another consolidation. Let me show it to you. When you go into consolidation or chop, you see the high volume? It's right there, right here. And look where it is, right at the overnight low. So we're auctioning the low. Here's the high volume. We break away from it. This now becomes resistance. And down we go. Now, where are we going? I don't know. Come back. Now, there's two ways to look at this. You're depending, and this is time frame oriented. This is resistance. We notice we pull back to it here. See the behavior? How this has order. So your stop would be right in here, right above this. Test low. Now the other side of this is volume is sitting there, right here. And we moved away from this. That is saying this auction, and we don't know, potentially is too low. Because when you do this, right, this is chop chop, this is your consolidation. And remember, what is a consolidation? It is an auction. Think about, so when you see this kind of thing, all this is showing you is the volume. Here's the high volume. This is retail in this store. Now, right in here, it looks like, hey, we're going there, no, didn't do it. Bang, buyers. So now I see the buyers, and I left this. Here, let's go back. I'm going to show you before it even happens what it looks like. So right in here, we're below here. We're below this high volume node. So going, break down, getting the champagne ready. Got it in the ice bucket. High volume is here. We are below it. Resistance rejected. Feeling good, Lewis. High volume here. Looking for it not to come back above here, but to break below here. So this is my area that I want to, get below. Keep going, right? Looks great, huh? Uh-oh. What happened? What are these guys doing? See? And a buy iceberg steps in too. Thank you. Appreciate that. So right here is my volume. I need to get below this to continue. If I can't get back below the high volume, then this trade, that's support, okay? So let's just look what it does. Watch. Here is your volume. See it? There. Think again, how do we think of this? I look at buyers and sellers, and I think that in where the volume is where there's an agreement on price between these guys. They're battling in here. Now, here's what's important about it. Is this price too low? Now, we don't know, but when we see the buying, it's like warning Will Robinson moment, but look where we come. Oh, too high, resistance. Too low, too high. Break up, warning moment. It's that, uh-oh, because of the buyers. Pull back, and you got to clear here. Support. What do you do? And this is, remember, resistance. Not so much. Out of the trade. Are you okay with that? Oh, here's another one. Now, I haven't seen these, so I don't even know. This is your VHVN 3920. And there's another thing about 3920 that's kind of important. Let me just mark this, and I want to show you the symmetry. The thing with this is, at least the way I kind of slice and dice it, I look at high volume as a very important element. Do you remember we had a target yesterday coming down to 39.19? Just reminding you. That was retail that was left behind. So it has some relevancy as a previous location. This, in our current auction, was too high. Let's look at what happens. And that's at 39.20. Where do we come? 39.20. Now, guys, I'm going to offer a thought, and nobody needs to agree. It's not about right, wrong, or knowing. I want to underline, I don't know anything. All I know is the auction and potential participant behavior and levels and what happened here. This is too high. And what the shoppers, these guys, the participants tend to do is come back and check levels. So if we blow through this and remember what's sitting at the mid and the VWAP, stops. Is it reasonable to anticipate stops? Where all retail traders keep their stops. This was where it was too high. 20. What happens at 20? Let's look. And if you're in the Trader Lab, guy, you all have these. These are called setups. What happens? No idea. It's all random. So what happens? Let's look. We come up to our level. Coincidentally, underlined in quotes, there's a liquidity sitting at our level. Isn't that interesting? Huh. It must be a coincidence. Or is it? I'll let you figure that out. I'm still figuring it out. Here's your high volume. Break, there's your seller. You see the change in the behavior. Sellers pull back to the volume fractal. In other words, pull back to the volume, developing time frame volume that we left behind, too high. Seller, microstructure right here. There's your volume. So there's your break. Here's your test. This is your short. This is your stop. And now you're back in the game. And where are you going? Here. This is called mean reversion. Let's see what it does. That's your scale. And now you just have a helmet on, and whatever happens, happens. There you go. Is everybody tracking? These are Trader Lab setups. If you're interested in this, I invite you to come to Trader Lab. Download the 60 PDFs. So now when the stream is on, since I don't start until 2 hours after the open, that's why I always go back. Because the thing about, at least for me, and this is just the way I've kind of reverse engineered the behavior of the market, it's how does it develop? Because if we're in a trend configuration, we're trading it one way. Like yesterday, if you followed the stream, it was just short, 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 tons, right? Today, we had two-sided trade. It's a different configuration. But in a downtrend, you don't see me getting long. I'm not saying you can't. I'm saying I can't, because who is moving forward? Which army? Who are the buyers? Are they short covering? And are they weak hands, in other words? Well, if you wanted to get out of the market, if you're holding something, would you be using the rotations up to be seller, or would you really be a buyer? Now, I'm not saying it can't go higher. I'm not saying, because I don't know. But the way I look at it is I only want to be on the short side because that's where the wind is. It's at my back. So I'm only looking to sell outside, back in. And potentially, I know I have another target down here at some point. Odd. This is a higher time frame target down here. So in the higher time frame, this is where I'm looking for this thing to go. Not necessarily now, ever, or never. It doesn't matter to me. What matters is I know that what was above us was too high. 39.15, this is a higher time frame volume point of control. We are checking it. It came, and this just shifted down, saying too high. So let's watch this. Remember, we can come back and check this, or this is going to push us down. So it's just shorts for me. And then it's trade management, guys. So short, this is another short, right? And now holding. If we can do this, is resistance now is up here in the developing time frame, and we can push off from here. We'll see if it does it. We're below the IB, and this is negative potentially. I always say potentially because anytime you put a trade on, it's like, I don't know. And this is the thing nobody wants to hear. Everybody's looking for certainty, and I have to tell you, there's no certainty in this. I think, for me, and I've been doing this almost 43 years now. And it's still emotionally, there's all the noise is still in my head. But what I've figured out is any trade, the outcome is random. My job is to get risk neutral. It's like buying a ticket to ride for the runners or runner if you're running a two lot. And then what happens? I either comes back, takes me out, I scratch, right? Or I take a full stop and I have some choice words I utter to release my emotions. That's okay. And it's overhead and cost of production. It's just the reality of the business we're in. Remember the casino. That's the business. Write that down. You're like the casino. If you can execute a vetted trade plan, and remember, your whole job as a trader is to just wait for the bus, which is where's your setup, and you already know where it is. You are anticipating it. You know the condition of where it might show up. Now, we don't know where, we don't know anything. We don't know. But why was it only shorts today? And why were we looking for responsive buying? And where is the outside edge, which is very hard to find, for what's called mean reversion, which is outside in from the top down? That's all part of a trade plan. Now, trying to find the location to interact for that outside in trade, that's where you're going to pay with a stop. And you got to get over it. It's not, it is what it is, right? It's just the business. It doesn't make you a good guy or bad guy or lady or girl. It doesn't make you smart or brilliant. It's just random. Please write that down. You have to take yourself off the hook. In other words, that ego is a big obstacle. And the hook is about the trade plan. That is who you or what you are accountable to. And your trade plan is something that's created outside of market hours. In other words, your job is to wait. If you impulse in, FOMO in, oh, this thing's going wherever, it's going to zero and I got to be on it and it's not your plan, you're on your way out of the business. The Trader Lab is about creating career traders, and it's not, it's a toolbox. Here's process, here's how to maybe think or understand market mechanics, why it does what it does, and the random nature of it, it is. And then any interaction with the market has a certain probability. If you do the work, and you can do it one setup at a time, just one setup at a time, and create a template or process, then you can build it out. As you can see, this is a short, right? So that's a short. Scale is here. Now you're risk neutral. Now you have a helmet on and you just hang out. Stop can stay here subject to your time frame. Or you can manage it behind high volume as it develops. That's subject to an individual plan. How do you know what the best way is to manage your trade? How about doing the numbers? You see? Once you have the numbers, you are empowered. And the reason the numbers are important is it takes you out of the gambler side of the table at the casino, puts you on the house side. It also gives you the confidence to calm your noise in your head and your fear, because you can open your trade plan to the specific setup and see that it has X% probability that when this occurs, that you get risk neutral. If you get risk neutral, now you're not going to be flip-flopping emotionally. You'll be more willing to give the trade the room for rotation, because the market is, it can go like a bullet, but most of the time it's rotational because there's something called a harmonic in here, which is just ebb and flow, ebb and flow, you know. And if it comes back and takes you out, you scratch, your broker sends you the gift basket. Thanks for playing. And you go on to the next trade. That's as significant as this becomes. And it's over these large sample size of interactions where your edge shows up and the dollars flow across the table towards the house. And in this case, you're the house. I hope you find that useful. And does this make some sense? Do you have any questions? So that's kind of how it works, guys. You know. Um, so this is what we have, and now we're waiting. So now there's nothing more you can do with this. If you have a trade on here, you manage the trade subject to your process. And if you want to follow the stream and anticipate where the setups are going to show up, you go to Trader Lab, download the PDFs. You know, remember, it's not a trade calling room. If you have the PDFs, you need to actually review them. Watch the primer webinar I did so you understand the process here in this stream, and then it's up to you to derive benefit. If you're interested in the Trader Lab, you're invited to come and visit. It's a group of like-minded traders who are interested in a career in trading. Remember, this process is not for everybody. It's one way to slice and dice. But if you guys have been following the stream, I think the idea is consistency. So I just do the same thing every day. So this is our 20. This is our VHVN. This is a Trader Lab setup. So and now we're in real time, and now the thing is to manage this trade, and we are going potentially 3,900, and it just doesn't matter really, because I don't know how it's going to get there. If it's going to get there, it's not my job. I cannot know. What I need to be doing now, after getting risk neutral and having a scale, is to manage this trade. And for me, the way I do it is I look at the volume. Now, this is the fair price. Currently, this is unfair. It's too high. Okay. So we want to kind of stay, if we can, there's your high volume. So this is your resistance at the moment. Now you can use this any way you want, and everybody has to kind of find their own, kind of where your comfort is psychologically. I know traders that, they're going to manage it with a scalpel, and there's others that are more comfortable trying to move outside of the noise and go for higher time frames. This is where your work needs to come in, uh, and you know, yeah, obstacle rare. Yeah, it is an obstacle. It's the retail price. The thing is, what is happening to retail? It's moving lower. So if the participants are saying this is too high, that was our short, this is too high, and now it's moving lower, that is suggesting, potentially underlined, that that being too high and it's moving down. What it's saying to you is all of these consolidations where we had these VHVNs, right? Price is too high. Price is too high. And now we're down here. This is retail. Now the market can come back and check a previous price, just like it did up at 20. But those are setups for us in a downtrend configuration. They're not longs. So if I see a long currently, if I see a long, it's a reason to cover a short. It's not a reason to get long. At least for me in my plan. I'm just talking me, and it's not a recommendation. There are traders who will get long and trade this because this is a target, you see. For me, it's just a reason to cover a short. It's not a reason to get long and then look to get short again. See? So that's how I trade it. But if you are a counter trend trader and you have a high skill level, see, for me, I can't, my stomach lining doesn't let me get long here because I don't want to trade counter trend in the current context. I want to use the counter trend triggers and structures to get repositioned with what I perceive to be the dominant side. It's just a different way to kind of think of it. If you are a counter trend trader, this is a viable long, but I kind of consider it has more risk than this one. That's all. Because I'm with the trend. Here I'm in the, you might say I'm really just playing the squeeze. See him? See these guys coming out. So that's why for me it's short only, and for other guys it's long and short. See, does that make sense? And Rare, did I answer your question on that? Anyway, I hope this is logical. Um, I don't think trading has to be complicated. It's tough enough, you know, and that's why I don't use any indicators, because the indicator is the participant behavior. You see, that's my indicator. It's what do the buyers and sellers think. It's ultimately it's not a you know MACD or a oscillator following this that tells me what's going on. I see it right here, right here, right here. That's all I need because it's the participants that ultimately is what the market's all about. And again, it's just another way to kind of put, find a way in trading. How can you relate? How can you get in sync that you can create belief in? Well, it comes from research. We've all done that. Years of study, throwing away great ideas that don't work, a lot of time, a lot of dead ends. Most of the things I would say a lot of you guys have done or are doing, I've done. I've been at it 43 years. I also managed money, as you guys know. So my experiences, I think, and over the course of those years, I went down many different roads. I mean, I don't want to even enumerate them because I can't remember all of them, except a lot of it was I did system design, trend, swing trading, trend following. I was not a day trader. That didn't exist when I started. In fact, we didn't have computers. There weren't even computers when I started, 1980. There were dumb terminals, um, and the Apple One, had just come out, that kind of thing. So that's kind of where we were with the technology. I mean, swapping floppy disks. When I used to get data to do research, you had to buy it on a disk. I'm just telling you. So, and over that time, I started out doing what we all do because what else? We don't know what to do, right? So, read a book, go to a seminar. hmm, There you go. And off you go down the dead ends and the rabbit holes. Um, so it was hard for me to let go of indicator world because when I was starting out in trading, Wells Wilder, and if you've ever read about him, he created a lot of stuff, BMI, ADX, parabolic, reversal. I don't even know, but all kinds of stuff. And I worked with that stuff early on. And then I worked with George Lane, shared an office with him, and he created stochastics, which, as you guys know, is an oscillator. And then I went into derivatives of oscillators and then built systems. So that's me. And all I can say is I wish there was more information when I started out. We didn't have an internet. We only had a book and a seminar. I don't know about you guys, but anybody read a book and have it change your life in trading or go to one of these seminars and come out? You know what I'm saying? Anyway, um, if you're interested in this, I invite you to come to Trader Lab. At least download those 60 PDFs. So if you are interested in the stream, you can follow the setups because you'll know what they are before we even get there. Um, I can't call trades because I don't need, like this here. This is a setup in the Trader Lab. I didn't know it happened because I haven't seen it. But once it's there it is. Here's your IB. So you have this short to the IB for the scale. That's a Trader Lab setup. This drops down is pressure. That says stay short. That's all it says. After that, it's, I don't know, trade management. What's your time frame? Now, here, remember this high volume? This was too low right there. So You can trade the targets. You can trade to this high volume here or to here and be done with the trade. What's your time frame? That's something that you individually determine. And that's what the idea of the Trader Lab is, to give you a toolbox. And then you kind of go, okay, and a template. Here's how you create this. Here's what behind all of this. And then you isolate setups. And then you understand and start understanding where that setup is qualified to be applied and when it isn't. That's why a generic process doesn't work necessarily in trading, because the market is in different conditions at different times, you know. And that's something that most retail traders don't understand. They think this is a business of indicators, not so much. So I'm just saying that's just another way to kind of slice and dice it. There is no right way to trade, you know. I would say that um, the right way to trade is however you can extract a statistical edge. Doesn't matter how you get it. You know, it could be a dartboard or the magic 8 ball. If you can derive a consistent statistical edge and you can execute it, then you're all good. Because that's all this business really is. How do you get that? Let's see. And if you can get it with an indicator, that's all good too. It doesn't matter. I mean, it really doesn't. I found that indicators for me didn't work. And part of the reason for that was they're not context sensitive. They're just generic, you know. So what might work one day, gets you run over the next day. And the reason is we're trying to apply a generic process. The market is not generic. The market is actually different. Interday it develops, it changes, you know. So here we go down. Look at the counter rotation, short, boom, counter rotation. This is rotational trading, you see. Short, boom, you know. And where does it go from here? No clue. And if it comes back above the volume, you just dump the trade off and you forget it. Nothing else to even think about. If you're short from 20, I'm all right with that, you know. It's just the way it is. It's just one trade. One of the things to think about is, a day like yesterday, what we work for is to interact with the market subject to what the market offers. We have no control. And that's about risk management, getting risk neutral when you can, taking stops and protecting your account. I mean, that's just what we do. All that is overhead. If you're taking losses, it's cost of production if you have a statistical edge. If you're gambling and taking losses, I don't think it's realistic to think that what you're doing is going to change, you see. So if you're not satisfied and you don't have a trade plan or a statistical edge, I would suggest maybe reconsider that approach if you're not satisfied with the outcome. Trader Lab, I think, gives you some tools, and then it's up to you to determine how it fits. I mean, in the Trader Lab, we have swing traders, option traders, guys who trade other markets just using this process. By the way, this works across all markets as long as there's a buyer and a seller and you got some volume. Doesn't matter, because this is what a market is right here. You're seeing a representation of what the market is built on and its participant behavior, not indicators. What did the participants think it's worth? So with the part, and right here, by the way, you'd be out of this trade. I'm okay with that. No, no problem. So let's watch the behavior. We're going to watch the behavior up here now for this VWAP mid VHVN. We're going to watch it for potential return here, not a recommendation. Let's watch. Not trade calling. You got to see a triggering structure. And even then, who knows? Watch. So stops are here and here. We're looking for triggers to come back here, not a recommendation. Let's see what happens. So you have to be careful here because there's stops and there's the mid, which is stops. Watch this guy here. It might skew the book. Let's see what happens. So you're looking for a potential trigger. So right here, see, here's your squeeze going on. So there's nothing yet. We're watching behavior. Let me look where the VHVN is again. Here, we got one here. So let's watch this. This is our most recent VHVN. So this is the area. Let's watch. You have to be careful with the mid. So this is what you call dicey, I think is the term. VHVN alignment, mid. Let's watch, see what happens. Location is funky, so this is where you got to be careful. Of course, you always got to be careful. So we're looking for potential squeeze, and now you got icebergs. Let's watch, and exhaustion and potentially stop pick. Not a recommendation. It's potentially in this area, and this is where we're going. So let's wait, see what it does. And this is not a recommendation. Okay, let's get some stops out. Less buyers up here. Let's see. Not a recommendation, guys. Let's watch it. Okay, here's your stops above the mid. Now, we want to watch for potential exhaustion. Let's just keep an eye on it now. Not a recommendation. Remember, retail trader behavior. Think like one, don't act like one. Let's watch. So nothing to do. So no trade there. Let me get back here and take a look at what's going on. $25 area to watch. Not a recommendation. We're just going to want to see if we get any behavior. This HVN right here. So this is an area. Keep an eye on it. Potential exhaustion. Keeping an eye. Got a selling iceberg sitting up here. 500 stops, 9-3 potential exhaustion, or up in these high volume areas out towards an outside edge, 25 above us. So this is an area, again, to keep an eye on. We'd still be coming back towards here. So we just have to watch. Not a trade recommendation. We're looking for structure. Here's some selling. Okay, watching. Nothing to do, and I'm not calling a trade. So let's observe it. It's your high volume. So this is your trigger. And what you're doing is you're going to go for your first obstacle for your scale. And here's why. We might get retail behavior at the VWAP or the mid. This is the mid because they're automatic mid buyers. Anybody here would just buy the mid. So we have to scale here in case it comes back and takes us out. So we're risk neutral. Then if the trade's going to work, we're coming back here. So we'll see. But this is your first target. Are you guys tracking? Remember, I don't call trades, but I'm just trying to share mechanics with you. Is this useful? So you're risk neutral in here, and now you hold. So here's how this would work. This is your high volume here. Now, let me point a little more out to you here. Now let's go back to context. I know this will make you crazy. What is this trade? What do we call this? This kind of trade. What is it? Anybody? Alan M. Oh, I think I answered your question. Mean reversion, guys. Thank you. This is called mean reversion. And the idea is if we think the trend might be down, and let's say we may or may not, I'm going to say maybe. So let's go back and look at this thing. Too high, too high. Remember 20? Now, here's how this might work. If this is retail, now there's a few ways to think of this. There's a few things. You got these VHVNs, which are too high, too high, too high. That's one element. The other element is this is retail at the moment. Now, if it flips back up, that puts to short, creates a problem. But until it does, it hasn't. When you remember what a consolidation is, somewhere out in the outside edge is too high. I'm not paying that. And then in the other edge, too low and too low outside here. So if we can identify an outside edge where I'm not paying that, we have the potential to come back to retail. And that's basically what's going on in this trade. So we came outside, and remember, we had a selling structure here, and we anticipate retail behavior here. So we have to scale here, and the trade fails if we come back above here. So you'd be risk neutral, and you'd have a couple burgers in the bank. And then either it comes up or, and this is your resistance, this right here, this high volume, which came out of here. So your stop stays here, not a recommendation naturally, and you're hanging out because there's buyers here anticipated, right? Why would we anticipate that? Does anybody know why we would anticipate buyers at the mid and VWAP? Retail, exactly. The reason we anticipate the counter rotation, and it doesn't have to do it, is retail trader behavior. In other words, the mechanical traders that go, oh, it's going up and I'm going to buy the mid and the VWAP. And I have no idea if they're going to, they're the gamblers, right? And they may win today on this trade. It's just one. So my job is to anticipate their behavior, and I have to scale before that counter force might come in. So I consider them and the location an obstacle. And in my trade plan, I got to scale because now I can sit here and not flip flop psychologically with every rotation and tick. Oh, it's down ticked, I feel good. It up ticked, I'm going to jump out the window, right? Anybody ever have that experience? So by having the scale and anticipating the counter rotation, and how about this? My resistance is that, I keep my stop above here. Where does it come back? Under here. Resistance. Huh. And what about these guys? What happens to them? Fuel. Where's my target? Next one is here. This is called, and who knows what it's going to do, mean reversion, right? So that was the short in real time. You know, for all of those who say, oh, you don't call trades. No, I do not call trades. What I do is give you 60 PDFs to download so you could see the trades. And then you anticipate them here in the stream. See, I think that's how we might learn, or I can at least transfer my experience. And that's all this is about, this stream. I'm attempting to transfer some experience, and maybe, you know, you guys can actually think about this as a business and then start approaching it as a business person, not as a gambler. Um, we take risk in this business and we get paid for taking the risk. An important part of taking the risk is knowing that we have a statistical edge. If we don't know that we have an edge, we are strictly a gambler. Um, and I don't think that builds longevity into our process. Here we have VWAP buyers. They may be right on this trade, and then they're going to take us out. And then that's just one trade. And if it comes up here, you scratch. Or here's the next thing. This micro volume right in here, this is an area to observe right here. So let's see what it does. So there's a few ways you can manage those. First of all, you can leave your stop here and it has to fail. That's one. If you want to micromanage it, this is your high volume in here. So your stop would be here, you know. So you would pretty much scratch the runner and you'd still have your scale in your pocket. So you'd still make burgers and pizza on this one. But this does not, so there's two ways. Here, up here, or here. Manage the trade if that's your plan. And you have to vet these ideas. So this will do whatever it does, and we have no control. Remember, it's all random. The idea is to try to use structure, get risk neutral, job number one, and then whatever happens is just random, you know, because you don't know. I don't know. That's trading. Any questions? Is this logical, guys? I mean, does it make some sense what you're seeing here? 46. I think you're asking me, you don't see it. It's right there. The other thing about triggering structures, they're an animal unto themselves, and it takes practice to read them quickly. See the high volume? See the reaction? See this? There's your volume. This is also another short if it's in your plan. Right back here. So this trade is safe, right? Remember where we're going, right? So you're seeing this one in real time. Nothing else I can do for you guys except just say this is there it is. And again, who knows? We have to, part of the emotional state of trading, needing to be right, the ego, uh, the fear of loss, not wanting to lose, that's all normal and it's just part of the way we're wired. The casino, when they sit when the dealer hands out the cards at the blackjack table, um, Okay, this just shifted. This is the VPOC. This is a warning Will Robinson moment right here. So if we can't break below here, this trade's going to be over because this is saying too low. Now remember, the possibility is to come back and check this. Trend is down. So this is now, if it comes back here, it's over. So this is still where we're looking. But it's the warning Will Robinson moment. What is it saying? Potentially too low. So what is the possibility? Uh, Roll up from here. That's right, of course, always has been. Or make sure this is really too low. So let's watch and see it develop. $46, you have Bookmap, don't you? You can open it up and see it. Exhaustion, micro, here, sellers, break, pullback, pullback, here, or break, pullback, here. That's it. So this one, if we get back above here, it could be over. All we did was test these guys. And if the trade is over, it's over. And that is fine. This is our warning Will Robinson moment, remember? That is very important. Right in here, you could just be out of this thing. It's up to your plan. That's why I said warning Will Robinson. That is saying this is too low. So the possibility, remember, what are the possibilities? Trade's over or down here. This trade is over. Are you guys tracking? So now in Park, that's about it. So this one, you would have your scale, and this was your target. Let's analyze this. The volume point of control shifted higher, which puts the trade in jeopardy. Right here, it needs to break and go here. It did not do that. This trade is over. Now, your trade management process is up to you. But this is in the Trader Lab also. This is VPOC migration. And you notice, what was the market doing? Let's go. Let's go back. Too high, too high, too low. See? So that changes it. Doesn't make it along. It means get out of the way for me. I'm not saying what it is for you. I'm just talking about me. So I just go to Park. Does that make sense? All good as far as I'm concerned. Trade worked. Trade did its job. Trade got a scale. Put a put a few drachma in the bank if you had taken this one wherever it was. I don't. I can't remember any one of these, but or maybe here. I can't remember. Rare. I would be in Park now because the condition has changed, and I just sit back. In other words, Sit back. One of the things here is when this shifted up, that was my warning Will Robinson moment. That meant that this was too low. Well, I want to trade outside in, but right now I see these buyers. I see 857 stops coming out. So let's just sit back. You know. Now I have my levels up here, my variable high volume nodes up on this outside edge. So I want to see what's going to go. Also, so you guys know statistically, now we took out the initial balance low. And to take the initial balance high out, I don't have these on the top of my head, but I think it's around 28% or so that we take them both out. And that creates something called a neutral day. In other words, both sides active. So it's possible we take out the high of the day. Now we have to see, and if we don't, it sets up another short opportunity. The short opportunity would be up in this area. But I understand there's a speech going on, so you might have short covering ahead of that. So that's a fundamental input. So we'll have to see what happens in here. Let me just check and see if it's the highest. Yeah. So right in here, we want to observe the 25 area, this high volume area. So we're going to observe it. And it looks to me like it's just a buy spree. So these are not trades. This is just observations right here. We want to observe it. 24, 20. So we're observing, right? Potential selling structures, you can see it. VHVN, potential outside edge, mean reversion. Keeps going, you take a stop, not a recommendation. This is that Trader Lab setup. Break, chop, break. So we can come back here. Or if you can read this, here's the thing, you'd be short here. This is why it takes practice to get unconscious competence. If you're very mechanical on this, you need to spend time on the weekends. So you can recognize this and not be trying to get back in here. Um, the idea is you want to be able to enter. Here's what the key issue is. The location is here. You would know that. What you don't know is, here's what you don't know. Are we going to take the high of the day out? There's buy stops sitting there. I mean, that's always possible, and who knows, right? So that's a Trader Lab location to potentially interact. And this is your triggering structure, this. So now what you need to be doing is looking to get risk neutral so you can keep your stop up above here or here, subject to, and now you're coming back here. This is still mean reversion. Now, what's it going to do? I don't know. Uh, and one of the reasons for it is why? This was too high here. This was too high. 25, 26. Remember, areas. Who knows? So, that's why we're looking at this. So this is your short. This is your back to the mean reversion. This is what's called mean reversion or outside in trading. And what you're attempting to do, and I'm not saying it's the right thing to do, if you think the trend is down and we're going to get the short squeezed, remember, if you run out of the buyers, which are the stops, see the volume, see the break, see the pullback, see there's no buyers, no buyers. You got Louis with the one lot up here. Where are the buyers? Where are the buyers? Where are the buyers? This is why on the weekends, you got to look at triggers during the day, go back and replay, look at them. I mean, study them, screenshot them, and see what changes in the behavior. See the green, the buyers, 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 the buyers. Hey, we're going through the roof, Alice. And location, this is the location. It's an area. Remember, horseshoes, hand grenades, and clueless. No buyers, no buyers. Louis, no buyers, no buyers. That is how I look at this. And it's very nuanced. But here's your volume. Here's your volume. See it? So you could be, once you understand, and this takes a lot of practice, okay? Once you understand, now you're using Bookmap. You're looking at, and remember, I look at this, and just me, as a chassis. In other words, this gives me all the volume for the day. I look at how the high volume moves throughout the day because that's where the shoppers or the participants are saying, oh, yeah, this is fair. Now we're not shopping here. We're out of here. Well, we can revisit the store. Where? I don't know. I just know areas of what it might do. Then I'm going to be looking because it's mean reversion. And what did I say about the initial balance high? Which of course can get taken out. Well, the statistics for that are low. It's like 25% or something that both get taken out, something like that. Well, that means 75% probability it won't. So I want to be short because the trend is down. Oh, and this was a target. See? Are you guys tracking? You got to keep an eye, right? So that's your, remember, mean reversion. There's the mean. Any questions on the mean reversion? So here's how you play this trade. Trigger, scale, risk neutral, job number one. Stop here. You can do other things with trade management. You have to vet it. This is resistance. Chop, chop, break low. Right here, you have high volume. This is resistance. There it is right there. See it? You can see this. It's all right here. So there's your volume, break, resistance. Volume, break, it's resistance. Developing daily time frame, higher time frame, volume, support. But it's the mean. So when you're here, you're coming here in the next fractal. This is fractal trading. And I understand you may go, what is going on? These are those Russian dolls. Higher time frame, which is the big doll. And then as you go down in those little Russian dolls, they get smaller and smaller and smaller and smaller. So this one is a developing daily time frame doll, right? And retail is there. And we anticipate the market to come back and check. That's mean reversion. In here, this chop is the little doll because it's a triggering structure. The retail up in here is too high. That's why we broke away. And now we came back and we checked this one. This trade could be over, or, and I'll tell you, in the trader lab, if you're running a two lot, risk neutral, flat, what's wrong with this? If you're developing, you see. If you're running multiple contracts, which is not the conversation in the trader lab, because the trader lab is really about building a process and a career in trading, and it starts with kind of a call it a fundamental process of vetting. And in other words, here's a setup. Can you recognize the context? Can you begin to identify the locations? What do you do, right? And how do you put a trade together? Well, by the way, now I don't know what this thing's going to do. By the way, this looks like some reasonable buying coming in. But right now, that's your resistance, you see. But this is your target. So this trade would be done, or you'd have another runner on and you'd scratch it. I mean, nobody jumps out the window about that, you know, and that's okay. This is your resistance right here, and we'll see what it does. But that trade for me, no problem. We came back right to the high volume. Now you got to see what it does here. What you're going to see potentially is symmetry, and that doesn't mean that what the market will do, because nobody knows that. So there's none of that. You're looking for that prediction tool. Um, I don't think you're going to find it in trading. What you're going to find in trading is you can measure the probability of getting risk neutral versus taking the full stop. Here's something I want you to think about. Just think about this. If you knew, based on doing the work and the research, that you had a 65, I'm picking a number out of thin air, so I'm making it up. Could be more, could be less, whatever. But you had a 65% probability of getting risk neutral on any trade that you have vetted. Would that help you put the trade on when it shows up versus no idea? If you knew that, would it give you courage? If you knew that, would it help you manage your fear? You see, that's the differentiator between gamblers and someone in the business of trading, is they know because they've done the work. And none of us want to do the work. We all want to trade. How about if you want to be in business? I think there's some work involved. If you want to compete against the other traders who don't do the work, maybe if you do the work, that gives you an edge, right? That's kind of what this is all about. Anyway, if you're interested in this, I've gone over my time. Come to the Trader Lab, download the 60 PDFs so you can follow along. And there's a primer webinar there that gives you an overview of these market mechanics. Thanks for visiting us. If you're interested, go to bookmap.com, join the Discord chat, come to the Trader Lab, and download the 60 PDFs so you can follow in real time and anticipate these setups. And also, there's a lot of additional education available, and it's all free. You don't have to be a Bookmap subscriber, and you won't be solicited. Thanks for visiting the Trader Lab, guys. Apologize for going over, and I'll see you guys tomorrow.